I grew up in the private equity industry where I bought a lot of small businesses here in the U.S. And so, have a lot of experience transacting. I will say more recently, I joined an organization called YPO. There's a YPO members in here, but I've met through that process a lot of other business owners, mostly here in the Southeast, and I've come to appreciate that they're really the backbone of the American economy. So I appreciate all that you all do. It's been a very interesting lens to hear about all the ups and downs of owning a small business here in the U.S. and have been impressed with just the scale and reach of some of the businesses that are much bigger than I would have guessed. Things like hanging drywall and doing wastewater treatment, much bigger businesses than I would have guessed. So, Matt asked me to talk a bit about putting you all in the shoes of a private equity buyer and what they're looking for when they think about opportunities. So I wanted to just talk through some of the basics of private equity, what private equity firms look for, how they when they look at your business, what they're kind of thinking through and what they're evaluating. We have a slide up front that just talks about the types of the different ways one can attract equity capital. And it really runs a spectrum of, on the top side,
you've got the slide deck in front of you, and then he's just going to reference for the folks that are out here.
I'm looking at page 4, I guess. Yeah, page 4. On the top side, you've got venture capital and growth capital are someone buying a minority interest in your business and likely having you continue to run it. So it is a great way to bring in, largely bring in primary capital. Primary capital would be money that comes into your business that has a use within the business. The secondary capital would be someone buying an interest in your business and you put that money in your pocket. Generally, these folks are financing some sort of growth initiative. Hey, I've got I run a service business that serves maybe the insurance industry, and I've now developed a software product I'd like to grow and develop as part of that. Maybe someone might give me venture capital to then hire more software engineers and effectively fund losses until that business gets to viability. Not really in scope of what we're talking about today, but it's certainly part of the mix of financing options that are out there. You have mezzanine financing, which would be taking on debt capital, usually again to fund primary projects. You don't usually do that to take secondary proceeds. But so again, that's going to be, hey, I want to build a building. I want to invest in some form of new business venture, build some software, whatever. Oftentimes, folks will take debt financing if they don't otherwise have any sort of debt within the business. And then the topic of conversation today is leverage buyouts. So this is the predominant type of private equity financing that's probably most relevant to you all. And on the next slide, we've got kind of this view of how that industry is carved up. I don't know admittedly about many of your businesses, but I would presume most of you would fall on the left side of the category, the lower middle market. These are going to be companies with kind of 1 to 30 million of earnings sort of things. If you look at how companies are generally sold here in the U.S., there are different cohorts of investment banks that serve companies at different sizes. So generally below kind of 5 million of earnings, that's going to be what we would consider to be a broker, someone who's just sort of they're going to blast out to everybody, and there's going to be pretty light diligence in terms of what the banker will do in terms of prepping you and getting you ready. Part of it is that's more of a numbers game. They're going to take on a bunch of ideas, post it on the website, and kind of see who wants to buy the business. 5 million of earnings up to sort of 20 to 25. You're going to have smaller investment banks. Generally, going to be a little more specialized as well, and they're going to really specialize in kind of bringing in a first institutional owner into the business. Typically, these are going to be founder-owned, owned and run by the founder or friends and family. And then at that point, you're kind of bringing in the first outside partner. And then, 25 to 30, you're going to start to hit the minimums of some of the really prolific investment banks that run really efficient processes. Harris Williams, Houlihan Lokey, here in town, it would be Black Arch. It would be, what used to be called Edgeview. I don't know what it's called now, Deloitte or something. But anyway, there were a bunch of them actually here in Charlotte that were quite good and remain quite good. Once you get to that size, you sort of can meet their minimum fee. It's important to understand the sell side landscape because if I had to describe what lower middle market firms are trying to do, the name of the game is to try to buy founder-owned businesses where the founder has not optimized the business. So you've got a business with 3, 4, 5 of EBITDA, and what you find generally is that in these companies, the founder tends to have come from the industry. They tend not to be somebody who's a trained CEO. They didn't go to CEO school. They went to, school of hard knocks. They did whatever the industry thing was, and they became the CEO eventually. And so what you find is that they tend to have undermanaged in terms of some pretty simple operational items. They've never pushed price increases on their customers. They've never priced their product based on value add versus just on, negotiated rates or things like that. They've never looked at buying their nearest competitor down the road who might have a lot of logical synergies with them. They've never hired a real CFO who can actually give them, pricing by product. Maybe half the products don't make any money, and the other half are areas you should really want to invest in. They've never, invested. We often find these smaller companies, you tend not to invest in talents. There might be the founder's terrific, but they're kind of doing all the jobs. They've got a good number two, and then like the fourth person at the firm is not somebody who's super qualified to be doing that job. And so the name of the game for these lower middle market firms is they get in there and say, I'm going to try to buy the company, on a multiple of what we call EBITDA. Do you know what EBITDA is? Everybody familiar with? Okay, so proxy for cash flow. And ideally you do it at a sort of low multiple, so to speak. You want to buy that generally kind of 4 to 8 times, I'll say on average. And whether it's 4 or whether it's 8, it's going to depend on a variety of factors, including, is your revenue project based? Are you in an area that is a hot area with a lot of organic growth? Are you in an area that's declining? So there's a whole range of factors that go into that, but ultimately that kind of comes out to they would quote it as, hey, I'm buying this company that has 5 million of EBITDA for 6 times EBITDA. And the name of the game and the way a lot of them make money is they generally are experts in certain areas. They might be healthcare businesses, which are actually very compliance focused. And so they tend to be really thoughtful within those verticals. And the name of the game is they buy these smaller businesses, ideally at prices that they need to be attractive. And they implement their playbook, which is usually some version of, again, tons of industries, but pushing price increases, looking at competitor consolidation, looking at other ways to optimize margin, whether, again, depending on the industry, whether it's, in the franchisee space, it's very common to do things like staff labor based on units, not based on dollar volume, because if you push price increase. So there's a bunch of different ways you do this, but usually they have some sort of playbook they're implementing. And the goal is to say, if you buy a company for 5, you want to get, let's say you bought it outside of a bank process or from a broker, usually you can then find things that are more kind of attractively priced because it maybe wasn't as broadly marketed. And then you want to sell it with those larger bankers I mentioned, where you can kind of dress it up, sell a story, and then get a meaningful kind of multiple uplift. And so you can see as you work across this page, lower middle market companies generally trade for kind of 4 to 6 times or 4 to 8 times. They tend to have, we say 3 to 5 turns of leverage. I mean, I'd say in most cases, they tend to have 0 to 3 in most cases. And, there's a pretty natural step up in size as you are in valuation multiple as you get larger. And the reason is because leverage becomes more available. And when you look at the fundamental math of how a private equity investor invests, it's a pretty simple formula. They assign an enterprise value to your business, which is just the EBITDA multiple times the EBITDA is enterprise value. Whatever the debt they can command is, you get to deduct, and the remainder is the equity. And so the name of the game is to try to finance as much of it as you can with cheap debt. And that's going to be dependent upon your level of durability of cash flow. And, as you get larger and these companies tend to generate more scale and become more predictable, they then can attract more debt and therefore command a higher price. And so there's a pretty natural step up.
Are you basing leverage off EBITDA or revenue?
EBITDA. And so we also find, you raise a good point, which is that usually as you get into the middle and upper and then the mega market, those are going to be cash flow based loans. They're going to be based on EBITDA. In the lower middle market, we actually see a lot of companies that are initially financed with asset-based loans, because what we find is that early on, the founder within the small business construct that's never had outside money, oftentimes the founder owns the real estate as well. And so they often will sell the real estate with the business. And so often one of the tricks of the trade is that you buy it and you actually finance the real estate and use that as a way to command a higher percentage of debt in the structure. And so that's a common thing we see to sort of juice equity. Obviously, more leverage is higher equity returns in theory. And so it's a common thing we see where folks will say, oh yeah, the real estate, if I'm going to buy the ice cream, I got to have the cone, like you got to sell me the real estate too. And so they'll use that to lever it into command higher returns. So you tend to see that as you get larger, these companies can support more leverage and therefore can support higher prices. We didn't have it on here. The third or the fourth one would be being public. And so if you look at public companies, those can generally support, conceptually, they could support very large amounts of leverage. In reality, they don't tend to have that for different reasons. But At the bottom here, we just for fun, put some firms here in town. So I don't know how much you all traffic with the firms here in town, but you've got folks like the Summit Park, which is a very good firm here in town. They're kind of a $300 million fund, very much a lower middle market investor. Carousel's gotten a little bigger, but at one point was more lower middle market focused. And then you have Ridgemont, Valferius. Ridgemont, obviously the old B of A private equity team, and then Valferius is the old CEO of B of A, his PE firm. Both sort of north of $1 billion. My guess is, I don't know this to be true, but I imagine it's true. At $1 billion fund, you can work backwards and say, hey, you probably want to have 10% of the fund in each company. So that's probably 100 million of equity. So you can then work backwards to, okay, if you on average lever it kind of 1-to-1, it's about 200 million of EV. So they're going to be paying, if I had to guess, they're paying 10 times EBITDA for 20 million EBITDA companies. Rough heuristic of what they're doing. I will say from GEM's lens, just so you know, we mostly invest on the left side because that's where the juice is. That's where you tend to see the highest returns. I am giving you all the tricks of the trade so you guys can optimize it and lower the PE returns. But I will say we find the fattest pitches tend to come on the left side because you haven't found that the businesses are optimized by 20 Harvard MBAs just yet. And as you go to the right, you really get into pretty sophisticated value creation initiatives, which are much more about like industry structure, changing the customer value, things that are much more McKinsey value proppy type issues, as opposed to like, hey, we've never raised customers' price and we doubled it the day after close and they accepted it kind of thing. Like that's low hanging fruit. Whereas you tend to see as you move to the right, you're working on much sort of more complicated things.
We talk about for just a second.
Yeah.
So you just fired the fourth employee. Right, you said you didn't fire him. You said
Yeah.
the fourth, 1 and 2 were good, and then the fourth and fifth. The fourth employee is Matt. No relationship to that Matt.
Yeah.
It's a different Matt.
Other Matt.
Just got laid off. Been with the company for 22 years. They sponsored the little league team, so he's not an A player, but he's been a loyal employee, and then you come in and you execute the playbook, which means we just made the whole business stale and not a community player anymore, right? We institutionalize everything, right? And so for somebody that spent 20 or 25 years building out a business, you just fired my fourth employee, Matt, who
And probably your brother-in-law too.
Brother-in-law, just left him at home without a kid. I mean, it's just his kid
hard
done
out there.
that,
A little too real.
The straw man is
But I mean, it's how do business owners manage through that reality, right?
Yeah, I think we often see that private equity firms will use it as a negotiating chip. So they'll usually be like the kids are in the business, and I think I bought a lot myself, and I would say 97% of the time the seller knows in their heart of hearts that the son is not the answer, and that they bought him a job, and so we often see it become sort of a negotiating point. It's like, yeah, I'll keep, Matt, we'll give Sam a job over here. He can work we'll give him red staple, put him in the basement. So you see that quite often, and what usually happens is there's sort of a negotiated, like, 2 years we'll have a standstill, and then 2 years later we'll kind of close that department or whatever, and so. You find that, and I mean, I empathize with this, and it's sad in some cases, but like usually the person who built the business is usually a remarkable talent, right? Just by definition, if you're an American entrepreneur and you build a 10-15 million business and sell it, like good for you. That's a hard thing to do. It's not likely your brother-in-law is as good as you are, and so that's just the cold hard reality. But when you're at the Thanksgiving table, it's not that sort of will spoil the turkey if you bring that up. And so what happens is they tend to kick the can and then leave it to the PE firm to sort of solve these problems. And so we see often that some of the value creation is like just, if you replace the brother-in-law with a real controller who has a CPA, suddenly the cost pricing gets a lot better. And like, there's just certain things that you tend to see done very effectively. You see over and over. And so one of the things, it raises a broader point, which is that one of the big issues we see in small companies is they struggle to attract talent. And oftentimes the reason is because the good ones that we've seen operate most effectively tend to have a model of, I'm going to hire, a young, talented, I'm going to take a chance on a kid from Clemson who seems really talented, who's younger, and I'm going to give him too much responsibility too soon. That generally works quite well when you take talented people and give them a lot of rope. And I think where you tend to see them run into issues is, again, the brother-in-law is the head of that department and they're threatened to, what have you. And so you can just see where, they struggle to especially even if they can attract it, retain that talent, because eventually they know, like, I'm never going to be above so and so. And so I think we should talk maybe now about like, I think I don't know that you all necessarily looking to sell, but to the extent you are, I would advise that you will leave a lot of money on the table if you leave those problems to the next buyer. And so I think you will do yourself a real favor if you clean up your books, if you have a real set of financial statements that are ideally reviewed, if not audited. If you give them real pro formas that takes the car and the vacation and all that stuff out of it. And everybody knows we do some of that, Gem. I'm an owner of Gem. Like we do some of that as well. But like we used to buy all these companies where it was like they would report, they'd be like, it's 8 of EBITDA. And we'd be like, well, your financials say 2. And like, well, that's because we took 6 of, we got this and that in the car and whatever and the insurance. And so the more you can clean that up and provide ahead of time, a lot of where these firms try to make their money is they actually think you don't know what your earnings are. And so, you think you're selling a 4 million earnings business and it's actually 6. And so I think by doing some homework and working with smart guys like him, you can clean that up ahead of time and really know, here's the package, here's the value proposition. And I think the more you can position, you can almost put yourself in their shoes and position what the plan is. You kind of hand them the plan. You'll be assigned a much higher multiple. And so when you look at going from that left side where you were lower into the middle, the way you sell to a middle market firm, to be clear, is you clean up the management situation, you have a clean set of financials, you have ideally an end market with organic growth, you've pulled all the easy levers, you do 2 add-ons of nearby competitors, and then you line up 10 more. You go ahead and set up the facility, and you go to the next seller, the next buyer, and you say, I'm selling you a business with 15 of EBITDA, but it could be 25, if you just get all these deals done. So all you got to do is, do these 10 deals and problem solve. Now it's a lot of work, as you know, so it's not as easy as that, but they will delude themselves into believing it's easy if you tee it up for them. And so I think as an owner, the more you can do that cleanup work and sort of present it to them, the higher the value you'll command in the business.
Makes sense. I'll keep pinging you with random questions. So.
Okay. Yeah, no worries. Unless there are other questions, I was gonna start to get on page 7. I think can't emphasize enough preparation, and really, again, a lot of where these private equity firms in the lower middle market make their money is just in how these small companies can be misunderstood. And so I think these were some ideas we put on the page, but financial preparation, having a clean set of financial statements with an accountant of some sort of, that's reputable. Again, ideally they're reviewed or have some standard of how they're cleaned up. And again, it's okay to show pro forma saying, look, yeah, I run the car and the plane and whatever through it. Like, here's the real, he's a guy who would be buying. I think the more you can present that in a very clean way with some history, very important.
Question on that, when you just say clean, just again for clarification, do you mean clean in terms of don't doing it, or clean? Sorry, clean in terms of saying like, yeah, I can easily carve out of like the goodies for the vacations or the.
I think you should do it because until you sell, it's yours, and you don't want to pay Uncle Sam. But I think you want to be very clear about giving them that. We see a lot of folks who sell a business where they're like, I've got 3 cars that run through the business, and 2 of them are mine, and 1's for work. And you're like, well, okay. And then you get into this whole like, now, if you're lying to me about this, what else are you lying about, kind of thing. Whereas the more you can be transparent with them about, hey, I don't know, you obviously you don't want to write them an email the IRS can print out and sue you with, but like, you can and verbally tell them like, hey, we made some adjustments based on some yada, yada, yada.
Okay.
And then give them some detail on that. So I think the more you can be transparent about it, and then ideally, if you have some history of the financial being assessed, reviewed, whatever standard you want to use, probably not audited. That's really helpful because again, where they make a lot of their money is on this sort of forensic analysis of like, oh, you thought you had X and you actually have Y. And
Thank you.
a lot of sellers too. I forgot to mention this. A lot of sellers quote a dollar amount that they want to be paid as opposed to a multiple. Huge bad. Don't do that. Like I'm surprised. We actually bought one recently where the guy was like, I want to be paid $40 million. And we were like, well, is that enterprise value or equity? He's like, I don't know what that means. I want a $40 million check. And when he did the math on it, that was like 3.5 times EBITDA or something. We would have paid him 6, to be clear. We were like, oh, great. Like, where do we should close tomorrow, kind of thing. So like, I think you do yourself a real disservice when you think in terms of dollars. Like you want to optimize your earnings number because that's what they're going to value. And then you can, the broker and they can compete on who wants to pay the highest multiple for that. But again, they will ding you on your multiple if they don't believe your financial statements. That's the number one issue we see. Operational efficiency. I think it's okay to like when you buy a small company, you expect there to be some things that need to work. And so it's okay to have that. I think the key is to have one, to acknowledge it, show them that you know those are issues. Hey, my brother-in-law's running commercial sales and we haven't sold anything. So like probably should look to upgrade there. Like I think it's okay to, leave a little something on the table for them, but like show them you know what you're doing is important. So just trying to identify anything that should be fixed ahead of time, and then anything that is a bigger, they're going to want to have some say in like who's the lead finance executive and who's the lead commercial executive. So like you don't want to necessarily do all that ahead of time. You want to give them something to work on, but I think you also don't want to be blind to, oh, they're great. Tony's been with me 20 years, and it's like, well, you're just surprised how often when you replace the finance executive, the whatever VP of finance or whatever, and you bring in a new one, and they're like, I never knew this is 20x better, and it's like, yeah, you've had the same person for 20 years, and you could upgrade it a long time ago. Growth strategy is important. Number one way private equity firms make money is by having earnings grow, and so I think obviously there's educating them on your end market, educating them on why it has organic growth tailwinds, educating them on the unit economics of your business are very important. I find often, I'm actually surprised often owners don't understand their own unit economics. And so that means if you, I don't know, again, know what you all do, but if you sell a widget, right? What does it cost to make the widget? How did you decide what to price it at? If I offered to buy 1,000 of your widget versus 100, how would you price it? Like just having some crisp answers, I think are pretty important.
Speaking of growth strategy, like hitting all of the potential growth that's easy, low hanging fruit to make the business as profitable as you can, versus leaving some of that out there on the table for the buyer.
Yeah.
How do you if I maximized out, and I don't know how to take it to the next level, but I've maximized, and so my tailwind looks really good, but I don't know what my headwind is.
Sure.
How does that work out?
Well, I think the ideal time is there's some optimal inflection point of you don't want to have reported recent declines. Generally, you're going to get dinged for that. But you also don't want to show rapid growth because people aren't going to believe that's sustainable. And so the ideal is if you have like some form of linear growth and a good story as to why that linear growth will continue, you're generally going to be assigned a very high multiple. And so that's what we've seen a lot of recently is you've had a really weird 5-year period where you had up until 19, you had low inflation, low rates, et cetera. Then you had a pandemic, it cost 40 grand to ship anything from Asia, up from 7 grand. Then you had lumber went to however much, way more. And so like you've had all these weird inflationary winds. And so you've had businesses that if you could be a real beneficiary of that in the sense that if you had like a cost plus model, suddenly higher prices was great for you. If you had a fixed price, if you're a fixed price aerospace manufacturer and everything suddenly cost more, your margins were down. And so it's been a really challenging time to sell companies recently because a lot of them will come to market and say, EBITDA has grown at a 40% CAGR the last 4 years. And they'll usually we're not building less airplanes, or they'll give you some like kind of BS answer. And like I think sellers or buyers are smart. They'll do some work on like what's causing this growth. Is that price increases? Is that fundamental? And they'll understand what the drivers are. And so I think the more you can understand that and then tell a story, be in front of that. And I'm surprised how often sellers try to kind of hand wave it away. It's just because we're great. That's why, because we're us. That's why we're growing. And I think the more you can say, yeah, listen, we're up because we are levered to lumber prices and they have been up, and that's certainly a thing. But if you look over 25 years, we're only actually at the average. And so you can tell a story and still get the answer, but you will be dinged heavily if and you will be disappointed on your multiple if you think, oh, I'm up 3 years in a row because of some variable I don't control, and now I'm going to sell that for 10 times. Like that's just not it. People will see through that. And frankly, lenders won't finance it. That's actually probably as big an issue as even if the equity wants to believe it, they're going to need a loan. The bank definitely won't believe it.
Stay on dinging. So you're kind of talking about dinging as you go through the due diligence process, right? It's one of the reasons we talk to clients and they say they don't want to sell to private equity because they know they're going to get into the due diligence process and they're going to get an offer here and then they're going to get ding, 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 all the way down to the point where, well, shoot, I had what I was looking for and now I got 60% of what I was looking for because they took away everything once we got into the negotiations. So how does a business owner manage through that?
Yeah, I think the one is to get them to give you a detailed offer. So oftentimes they'll quote some high level. Hey, I'll give you 6 times your business. And it's like, okay, like tell me more. Like, what enterprise value? What are the deductions? I always tell when I've had friends that have sold, I'm like, tell them what cash is in your pocket. Tell them do the math down to pre-tax income. Where you tend to see a lot of the shenanigans have been worked out that the people used to use. The one that still is quite prevalent and is the biggest issue by far is working capital. And so again, we see this often in businesses with large working capital needs where, what you'll find, we see this a lot where it's like, okay, business has grown a lot and by the way, it's going to keep growing, but it's a business that as it grows, it consumes more capital. And so the seller will think, well, I'm just going to take all the working capital with me. And the person's like, well, no, I paid you a multiple for the growth. You got to give me the capital to fund that growth. And so that's where I think you tend to see like, oh, I thought I was getting, 50 million in cash. And then there was an adjustment that was 20 million at the end. And so I think the more you can set a target for that and understand it, it would be helpful. It's actually really important. And the target is going to be set based on some assumed level of, this is where you're going to want a, smart financial mind to help you, but it's going to be set based on, okay, you got inventory, what's the, inventory turns, days of inventory that you need to support the revenue, what's the days payable, et cetera. So there's going to be some assumptions they make, and where some of these PE firms are really good is they come in and say, I'm going to set artificial targets. I'm just going to across the board, they've historically operated at, and you actually see a lot where sellers won't always collect as fast as they should. They'll do stuff that's not as efficient. And so they'll use that against you and say, oh, well, you usually collect in 60 days and or you usually pay in 30 days. So I need 30 days of receivables. And it's like, well, the day they close, let everybody say, now it's 60. And so they'll like just free up some of the working capital, put it in their own pocket. And so I think as a business owner, the more you can clean that up ahead of time and make sure, one, you have a clear expectation as to what it should be and the underlying logic for that and why that ties to whatever growth projection the potential buyers, that'll be really important. But we see that a lot where people say, oh, I'm forecasting a bunch of growth and pay me 10 times for that. And someone's like, I'll pay you 10 times if you give me the capital to fund it because it's both. That's a big source of disagreement.
Some one more question in that same vein, since you mentioned smart minds. Anybody can sell their business isn't going to talk to somebody about helping them sell their business, right? Whether it's on the smaller end, it's a business broker, M&A, investment banker, whatever it is. Yep. Everybody's got a pretty deck. Everybody has a story that they can tell. How do you separate that? What makes a good M&A bad for y'all in terms of negotiating against you? What are the key things that you look for as you had to sit across the table from the good ones that are arguing really hard for their clients?
Yeah, I think the more they can, I think it applies to anything in life. The more they can articulate why, that's helpful. I'm surprised within the private equity community, the business brokers have a very poor reputation because they're known to be kind of like salesy, kind of sleazy bunch in general. So they often will make promises to owners. Oh yeah, I can get, I'll have you sold by Christmas, and they'll like throw you on the Sunbelt website. And it's just not. There actually was very little diligence. Like they don't really coach, and so I think if the person seems high quality, not because they have a great golf swing or because they look good in a blue suit, because they actually know what they're talking about, like that's probably a good sign. And then I think I always find just keep asking why. Like generally, you're going to kind of pretty quickly ferret out whether they're serious and understand something or whether they're just kind of blowing smoke. But again, a lot of the brokerage community it's a volume game. They actually don't necessarily make a lot on any one deal. It's about kind of the volume of deals, and so I think we be mindful when you negotiate the fees with them. Like in some ways, you'll get what you pay for, and so I think if you get the cheapest one with the best fee, you may have won the battle and lost the war kind of thing. So there's no silver bullet though. You also send me, I'll interview for it if you want after the serve as a free advisor.
It's awesome. Thanks.
Yeah, it's funny. My colleague Lindsay, who runs our small buyout strategy with me, she worked with me at Stone Point. She left Stone Point and Greenwich same time I did, moved to Atlanta, and she and her husband bought a fleet washing business. The largest franchisee of Fleet Clean. You guys know that they wash yellow iron before it gets shipped to Russia, which is the last thing they do. They put it on the boat. Great business. She jokes like, she went to the school of hard knocks, like boys pulled guns on her, like all sorts of stuff happened. And they eventually professionalized it, grew it, and sold it. And they were so disenfranchised by the experience they had that they actually run their own little brokerage now called Ryco. Okay. So her husband, she works here now, but her husband runs it. And the stories we should have him as a speaker because the stories he tells of like some of the stuff he sees, and mind blowing. It's truly the Wild West. So,
It's great.
Let me ask you a question. You think will be smart to put your business to sale, listen to the offers, get ding, and then turn around, fix all those issues and turn around and try again with him?
yeah, I think
Or Charlo is too small.
you probably
that you
get
guys
one
push
bite
it.
at that apple. So I think that there definitely are owners that are like, thanks to the playbook, I'm gonna go do it. But like word spreads, and so I
That's
feel
what I
like,
said.
you know,
Charlo too small that
yeah.
assume.
I would also say, like, hopefully one of your takeaways from this is like, you should do a lot of prep work before you go. Like, I think it's easy. I think you see it a lot where people are like, some broker calls, like, your business is worth 10 times. And you're like, here's my 24 numbers, like, let me know what the bids are. And it's like, no, that's where you got to do the prep work. You got to get it all. And so it's like, if you're going to spend the 4 months, presumably you should be, and I find that tends to be the best value maximizing thing. It's also worth saying, oftentimes, most private equity wants to keep the owner by definition, as we established up front. The owner is a force of nature. He or she built this damn thing and got it to where it is. And so they don't want you all to go away in most cases. They actually want you to stay there. They want you to roll a substantial part of your equity and you get that second bite of the apple. And so there is some, like, if you're retiring, sure, it's fine. We see a lot of baby boomers whose kids don't want the business, and they sell, and that's it. But you know, if you're gonna roll and stay with them, I think the more you can clean it up and then vet the partner ahead of time, and then you can share in that value creation. I actually think that's a great way to create kind of a win-win.
Thank you.
Legal and compliance is an important one. We see often that there, especially in certain industries where, you know, if you guys are doing any sort of bonding work, doing work for the government, things like that, like those are contracts that are kind of like for death. And so people are going to want to really scrutinize those. And so I would say scrutinize them yourself first. Do the work ahead of time, make sure you got your ducks in a row. Because that's the sort of stuff that people will walk away and or they'll heavily discount what the valuation would be. Buyer engagement is important. This kind of goes to what I was just telling you. Like, oftentimes they want you to stick around for, even if you step away, they want you to roll some, just so they don't, you didn't sell them a lemon. And so that's where I think it's kind of fun, where you can kind of get in their shoes and say, well, this is somebody actually, ideally it's a partner you're talking to that you're like, I never thought of that. It's a great idea. Like, do that, you know, while I'm gone, kind of thing. And so, but it's also somebody who has a track record of treating their partners well. I would call up some of the prior founders they worked with. And I'd ask for, you know, two that have worked, two that didn't, kind of thing, just because you want to hear how they treated the ones that didn't work out. Oftentimes the way these are structured when you roll over is your equity is subordinate to the equity of the sponsor, which works fine unless things aren't going well, and it works real poorly. And so I think just understanding, you know, what your rights are. Some, not all, but some private equity firms, part of their strategy is to get you to roll a piece and then come to you later and try to buy it at a discount. There's, you know, you just want to just do your homework on having the right partner. Again, I would say 80% of small business owners, I would hazard a guess, that sell and roll, like, have a good experience, to be clear. So it's not like this is bad. It's usually ends well. But I think the scope for misunderstanding is high. Picking an advisor is critical. I agree with that, and then prep is critical.
Talking about the current environment of selling to private equity, we think about 2000 or 2020, obviously COVID, 2021, the market for private equity, right? Like, all of a sudden, everybody was selling private equity, they were SPACs. So like 2021, beginning of 2022 was super hot. And then everybody said, oh gosh, the market's overinflated, and kind of maybe sort of pulled back a little bit. And then now we're in a world where it's the opposite. The equity market, the public equity markets are quote unquote overvalued. And private markets might not be. So
Sure.
What's the world like for private equity for 2025 and 2026 and 2027 look like from funding deals? Are they cautious? Are they still sitting on a boatload of money because things were unattractive from a price perspective, or they couldn't unload past deals? Let's just talk about their appetite for deals going forward over the course of the next couple of years.
So there's two sides to this. There's the capital market side. So there's like how much money is private equity raising to put equity into deals. Robust. Lots of money's been raised by your businesses. So that's not an issue. And then the second, and probably just as a more cyclical issue, is availability of leverage. And that's going to be a combination of just the absolute real level of interest rates, which Jay Powell controls, and then the spread, which is the amount of money sloshing around the market. Leverage is oxygen in the LBO market. So when it's not available, you tend not to see transactions happen, which is really what you saw in 22 and 23. More recently, the leverage environment's been much better. Obviously, you have a Fed that's now cutting rates, at least for now. But importantly, you've had spreads compress pretty meaningfully. Part of that has been that there was a ungodly amount of private credit money raised, both from institutions and from wealth, frankly. There were a bunch of 40 Act funds raised, and they have one flaw, which is that the money shows up day one and they got to put it to work. And so we see that they call our sponsors and say, hey, you're financed at S plus 700 a year ago. Do you want S 550 now? And their equation is I'm sitting in T-bills at 4, so if I can finance it at 11, that's great. Even if I took a credit that was being priced at 14 by the market and priced at 11, now that's not a part of their equation. And so the availability of credit has been much better. And so you've seen where equity can now afford to reach a little more on price. And that tends to bring sellers back to the table, right? Because that was you can look with hindsight, like the drop in interest rates really just went right into sellers' pockets effectively with higher prices. And so you're definitely not back to the heydays, but you're from a capital markets perspective, you're probably at an equilibrium, I would guess, relative to history. And then on the fundamental side, I would say the picture is hazy. It's honestly a very confusing time where we have some partners that do industrial investing, and they would tell you like we're in an industrial recession, like backlogs are down, like big customers are behaving very quickly, just a very difficult time. Healthcare has gotten very challenging with labor inflation, so healthcare is sort of out of favor now. Technology is value created, so there's all these things that are kind of fundamental headwinds, but it's very company specific. So I'd say if you have a business that is in a favorable end market with organic growth, it's up to provide some input into how data centers are built, right? Which is everybody's favorite thing right now. Like, sure, that'll sell tomorrow. Please bet the market quickly. But I would say most businesses, people are there are some strange crosswinds after 20 years of globalization and offshoring and whatnot. Now you have a lot of nearshoring, you have an incoming president talking about tariffs, which have, some real pros and some real cons. And so like, it's just a very hard time to underwrite fundamentals, especially in small businesses. And I will say, you haven't really had, since the GFC, small businesses in the US have largely been insulated. They've been pretty well protected. And the only time they were ever really truly challenged, I would say at a systematic level, was during the pandemic, when pretty quickly it was a solvency crisis of like, hey, revenue might be zero for a while, which is like, that's a bad day at the office. And then the Fed nationalized credit, right? So the Fed sort of stepped in and said, we'll just guarantee the whole thing and kind of solve the problem, which was helpful. But you haven't really been challenged. And so it'll be interesting to see, how I'm not sure inflation's been tamed. We're talking about tariffs, there's a push to nearshore. I don't know. It'll be interesting. I think you would need to know a lot about the company to know whether it's a fundamental winner or at a headwind today.
How much do the funds themselves look at that perspective? Like we've got construction, marketing, restaurant, more construction on the call. Like, how much do the funds look at the tailwinds or the headwinds for the sector versus it doesn't matter, the company's really damn strong and we're just going to invest in the company? Is there interplay there between what's ahead and what's behind?
Yeah, I think it's going to fit there. I mean, most private equity funds have 6 to 12 investments in the fund. So they have some inherent diversity, right? So they're not going to buy 12 of the same business, right? And so they're willing to, I think they are willing to accept some concentrated risks, certainly. But some of the businesses we buy have 50% customer concentration, right? And the plan was to buy the competitor across town immediately and make it 25. That's part of the playbook. I would say there are some heuristics that private equity investors tend to use, where they're going to want to see things they like predictability fundamentally, because ultimately they're dependent upon having access to leverage. And so the things they're going to be rewarded are going to be where revenue is visible and recurring, where costs are ideally variable and tied to the revenue. where the end market is predictable. So if you're serving, it doesn't matter what you do, if you serve an auto end market, people won't like that. They selling the GMs generally not well regarded, just as a general matter. It doesn't mean founder owners don't make tens of millions of dollars selling to them. It just means that buyers struggle with buying from people who do that. Whereas if you're selling into, I don't know who the big data center developer is here in town, but if you're doing all the development for that, yeah, it's probably people are gonna view that as like a AI tailwind play, right? They're gonna probably sign higher multiple of that. So there's definitely some like some bottom up business fundamentals that matter, but there's also some top down what end markets are you serving, what do you lever to that matter as well. And I think especially at the size we're talking in this room, I mean, no business is immune to whatever's going on in the market. And so that's where I think the more you understand and can articulate to the buyer, the more they will believe you and bid very credibly and aggressively. Whereas when you can't explain why your business is going up, they're going to be terrified. And or they're going to do their own work, come up with the real reason. And if they like it, they're going to underbid you. So that's where I think the more you understand your own business, the better. Cognizant that you said 5:45, get out of here, and it's already 5:40. So
Questions? I keep asking questions all night. So any questions on kind of current market? Fears that you might have about handing the keys over to somebody else and laying off Matt over there, right?
Can you talk about the industry valuations, like how is it determined? And what are all the top valued industries?
yeah, I mean, generally anything with it's going to be a combination of business characteristics and organic growth tailwinds. So for a long time, I'll tell you so anything software generally is highly valued. And the reason is that view that it's hard to pull software out, and we all probably use software, and it's like, you're mad at your software provider. It's hard to pull your software out. So it's a very sticky business, can be therefore very leverageable. So it tends to trade a high value. I would say for a long time, the most favored industry was healthcare, because you have post-Obamacare, a push for access over containing costs. So revenue went up and costs didn't keep up. And so you had margins that expanded pretty dramatically. And so it was almost, I mean, it was kind of like magic, frankly. You'd buy a healthcare company, it would grow, get bigger, and they'd sell it. And like there were a lot of people who did that for all the time. And then during the pandemic, what happened was a lot of these are reimbursement-based contracts. So Medicare is a fundamental payer. They update their rates every few years. Well, if the cost of nurses triple in a year, guess what? That's your problem, not theirs. And so they don't come out and say, oh, so sorry, we're going to rate. Like, they don't care. That's your issue. And so you saw where it went from being in favor to out of favor. So actually, two of the firms here in town, they're on this page, they closed their healthcare practices. They don't invest in healthcare anymore because they think it's a bad trade. Today, I would say the things that are next on the hierarchy would be anything that's like a high quality service that has either recurring or reoccurring aspect to it. For a while, it was like anything that was a residential service, plumbing, HVAC, roof, tree service, gutters, brushed, or whatever. And as you know, there's a HBS grad. There's about 50 of them rolling up every one of those areas. I'm sure you got all the time. Low barrier to entry, but very sticky businesses when done well, and still even to this day quite integrated to how they operate. I would say anything that is more project based is going to be just have a lower multiple associated with it, because again, what they fundamentally value is predictability, right? If you have a business that is where the revenue is project based, there's a chance that you don't have revenue or you have less revenue, and if you have leverage, that's death. And so what you find is that those tend to be businesses that they still sell, but you've got to demonstrate some real backlog. The hardest ones are ones where it's project based and the projects are like 6 months on average, where it's like you can't show them backlog, you just can't show them certainty. Again, they trade, that's fine, but like they just don't trade at the same level of value that you would see from larger. And then I would say there are certain businesses where I'm not sure anybody else could run it. I think those are the ones that tend to be the hardest to trade. I won't disclose exactly what it is, but I have a person here in town who's a YPO forum mate who runs a business that does reverse logistics, processes returns. And if you saw the factory and how it operates, I don't know that anybody but him could do it. I'm not sure anybody could ever buy it and replicate what he does. And so I'm not sure it's sellable, frankly, because usually the more something can kind of run itself, the more you're gonna have bidders for that. I think the more it's tied to you, the founder, in some way, the more it's tied to your know-how,
Hard to sell.
it's just hard to sell it.
Hard to sell.
Because ultimately you're selling your know-how. I think people really struggle with that. Again, that's where you'll want to do evaluation ahead of time, know that, transfer the know-how to somebody else, or somebody who can convince the seller or buyer that they have the know-how. Or structure some arrangement where you still provide it in some way, shape, or form. The other one's tricky, I'll say, is we see a lot of small businesses that are built on one key customer contact. So it's like, hey, I have a machine shop and Boeing's, 60% of my revenue, and the guy at Boeing that buys from us is my fraternity brother, and we play golf at Charlotte Country Club 3 times a year. And so that's just not a
Yes, sir.
replicable, unless Boeing signs a contract for 10 years, like, sure, that's fine. But like, what you find often is they're like, oh, yeah, Spencer loves me, it's be fine. Like, so buy the company and he'll still work with us. And it's like, no, I mean, who knows what will happen. So you tend to find those are heavily discounted because people can't rely on them. So the more you can make the business independent of you, the probably the higher the value.
How small do you get into in terms of EBITDA?
We work with partners. We buy companies as, I would say, for platforms. So maybe one thing we've covered, like, there's a question of like, is this the first business you're buying, and then that's kind of the main business that you're then going to add more management to, or is it an add-on? So is it a business you're bolting onto a bigger business that has management? Or platforms, I'd say 3 or more, in part because, small company CEO probably still costs $300,000 or $400,000, and so at some point you buy one per million and you hire a CEO, now you don't have an EBITDA, so it's kind of like, that was not useful. So there's some minimum amount of scale to be a platform, I think. And then for add-ons, we see companies spot all the time that are $500,000 or something, but they're going to be much more kind of, we say they taste like chicken. They kind of just, there's got to be a fast process to do it. It can't be a 9-month diligence process. Yes, sir.
Talk a little more, because I see my clients struggle with how you talk to the buyer when they're at, because almost all these deals are asking for 20-25% rollovers.
Sure.
I mean, that really is an issue that I see a lot of sellers see as a black box.
Yeah. Well, I think, again, the people who build these businesses are smart and know how to grow them. And so if I would ask the buyer about what their plans are to grow the business, if it sounds smart to you. I mean, what you're really doing when you roll is you're buying stock in their company now. And so I think if what they're saying sounds smart or novel or interesting, like, probably a good signal. To be clear, there are tons of horror stories of, PE thinks that if you just do X, it'll work, and it don't work. And people who know that, the people who are in that industry. So there's an old joke that, like, if you see an oil and gas deal that came out of Texas and Charlotte, like, something's wrong. And so, like, I think that's true in a lot of your industries, where it's like, if somebody's telling you like, oh, I'm gonna change the way your company works, and you're like, I know that doesn't work that way. It's like, that's probably not somebody you want to roll with. And so I think that's one. References are important. Talk to a couple of founder. I would actually get their marketing deck, get them sent to you. And then I would request CEOs from that. I'd pick the biggest winner, I'd pick the 2 biggest losers, and I'd pick one in the middle. And I'd say, hey, all right, the 2 that you wrote off, what happened to that guy? Where's he at? And then you can ask him, like, how'd they treat you? What happened when it was down? Did they have a plan? Like, you learn a lot by when things aren't going well.
Thanks, I appreciate it. Matt?
One more, I was looking at the graphs on page 12, it looks like there's a lot of money sitting on the sidelines. Am I interpreting that right?
Yeah, so dry powder is a measure of how much money's been raised but not spent by private equity firms. What you
So-
find it,
Deal flow's down, but there's more money sitting on the sidelines.
yeah, well, what you're seeing is that the appetite for private markets from like sovereign wealth funds and like really 100 billion pools is up. They would like to do more in private equity, in part because public markets are volatile as hell and they're tired of that. And so they'd like to put more in privates. So there is, the supply of capital is up. The issue is they're staring at the math that I was just telling you about, which is that they're going to sellers, and sellers are coming and saying, I want my 2021 value. And they're saying, well, rates are way higher, so I can't afford to pay you as much regardless. And by the way, the fundamentals are not as obvious now. So, a lot of deals don't pencil anymore to an IRR that makes any sense. So what happens is they're telling their LPs it's a generational buying opportunity and give us money for our new $1 billion fund, and then they're turning to the sellers and saying, "Look, guys, like, I want to pay you 6 times, you want now, what do we do about this?" And the bid-ask spread has been quite wide for quite some time. And so you're seeing that. I think a lot of folks will look at this chart and think, oh, like that means I can get a higher price. I think what will matter is the cost of debt more than anything. Because they will not put that money to work at 11% penciled returns. They need to think they can earn a teens return, and the way they're going to do that is by paying you less or financing it more cheaply. And you're not going to like the former.
I'll flip that on said real quick and let you talk about what you do. So if there's all that dry powder out there, how do y'all make good investment decisions into businesses like this and entities? Like, how are y'all not having the dry powder problem that's up on the board as an investor? So flip your hat and sell.
Sure. So this is a power law, the way this operates. So most of this dry powder is sitting with mega cap funds. So we had the slide earlier that showed the lower middle market, mega cap. Prices get higher, funds get bigger. Frankly, the private jet gets bigger for the managers. You get kind of go up that spectrum. The real money is made at the lower middle market, frankly, buying from folks like y'all and professionalizing it and selling it to the first private equity buyer. And so what we do when I was working at Stone Point, my prior firm, what I learned was when I started, we were about $1 billion fund. I was being asked as a young person to go to conferences, sort deals off market, try to buy for 6, 7, 8 times EBITDA. And I found there was a lot the founders hadn't done. So there was a pretty durable way to like double earnings over a reasonable period. And you could hire $1 million at low-key and sell it for, if I bought it at 6, and sell it for 12. And if I could double the earnings, and lever it, that was a great way to earn, 4, 5, 6 times your money. Once you got bigger, once I was leaving Stone Point, we had a $6 billion fund. We had a lot of success, results very good. And at that size, everything was kind of the same. It was like, here's a Goldman Sachs auction book with a main report and stable financing. And it had been owned by 2 prior private equity funds usually, who had optimized, they'd had every GE executive and a Harvard MBA in there to turn every screw just the right way. And I mean, it was all about like rates and, equity, what did S&P do over the whole period and they get through it. And so it was all things that like I as the lead investor didn't control. And so when I came to GEM, I just said, look, we should just focus on lower middle market. And so what we specialize in is backing small buyout managers, which we would define as folks who have a fund under $1 billion. And we have kind of a unique take on it, which is that we'll actually back a lot of these folks on a pre-fund basis, deal by deal. And then use that information to back them in, to eventually back them in a fund 1, fund 2, fund 3. I had a long track record doing them, but I don't know, Matt, $2 billion to work now since I've been here. But it's not, when you buy a company for 6 times EBITDA and you put 2 to 3 turns of debt, it's not a rate driven strategy. It's not what's going on with S&P multiple. It's about, did the person you back do the thing they said they were going to do? And if they have a plan and execute it, that has nothing to do with what's going on in the markets. And obviously, if you can invest privately and have attractive and uncorrelated returns, that would be the holy grail in any given thing. I will say, I'll just put a plug in for Portus. We at GEM, we have 35-ish nonprofit clients. We're Elon up the road, John C. Smith here in town, Aspen Institute, a bunch of great nonprofits. And then we really want to focus on investment excellence. So we have Matt, who's really our only kind of person who's out developing business. Our job, we want to have a small, close-knit number of partners that we work with. And so as we were looking for partners, and so this is not something where we have 400 RIAs and he's the 401st. We've just got a handful of partners we chose to work with, and so we're so honored that you agreed to work with us as well. Thank you.
Yeah, thanks for your knowledge, your time, your office. Greatly appreciate it, and for helping do due diligence on M&A advisors as they come across the table.
Absolutely. Got my email address.
So again, thanks everybody for coming out. Thank you for the folks that stuck around. It looks like some of them fell off. We're going to go down the street. If anyone wants to join us, we're going to go down to QC Courthouse, have a drink, an appetizer or two, tab for like 5 minutes, and then we'll close it. But no, feel free to come on down with us. Continue to talk. Matt, are you going to be Are you gonna join us or are you going home?
I may make an appearance.
They make an appearance.
Yep.
I think Jay's gonna take off, so it'll certainly be Team Portus. Don't forget, we'll have our event. It is December 12th. Right, is that right, Caitlin? Our next event with Harold Howell talking about insurance. Harold, just for reference points, one of our clients was staring at a $200,000 to $250,000 insurance bill. We brought him to Harold. And he helped repurpose their insurance. We brought down that about $150,000 to $200,000 a year as they went into a shared risk pool instead. It was a $25 to $30 million business, so it's great because they'll save $150,000 to $200,000 a year, which is good savings, right? That's nice to put in your pocket. But then on the flip side, when he goes to sell in 2 to 3 years, which he wants to do, we multiply that by 4 or 5 times, 4 or 5, 6 times multiple. Now we're talking about another $1 million in value created. Through evaluating that insurance, that's operating efficiency, right? So those little things that you can bring into the equation, that's a big win. We just saved $400,000 over 2 years, made another $1 million on the sale. That's good. That's good money. So Harold's going to talk to us about how he looks at insurance. He's been in the industry for 20 years. Does a really nice job, and where it might make sense for some of y'all as you think about it as well. So join us for that. And let's go down the street and have a brewski.
Cool, thank you.
Thank you, everybody.
Thank you.
I'm just. Oh, yes. What? Take care, thank you.